All right, everyone, thank you very much for joining us today. Today, we're going to be delving into a little bit of a different topic, especially pertinent now coming up with open enrollment starting November 1st, running through December 15th of this year. So if you are looking to change your health plan and you're maybe looking for something that is a little bit less expensive with different options, the health savings account is certainly a great area to start. And we're going to be going through all the details of the history of the HSA, the difference from other types of accounts that are commonly misconstrued as this, some investment options, and some case studies to show you exactly how these accounts work over time and what their inherent benefit is to you, someone looking to save on taxes. My name is Alex Perney. I will be your presenter today. I've been here since 2006. I obtained my designation as a certified IRA service professional in 2012. If you have any questions at all, please feel free to give me a call directly on the screen or email me. I will be more than happy to address any specific questions that you may have. A quick disclaimer before we do get started in the meat of this presentation. Advanta IRA and our employees, we do not provide any investment advice, nor do we endorse any products. All information and materials are for educational purposes only, and all parties are encouraged to consult with their attorneys, accountants, and financial advisors before entering into any type of investment. So what is an HSA? Well, easily enough defined, it is a health savings account. It's a tax advantage savings account for individuals with high deductible healthcare plans. Now, throughout this presentation, instead of enumerating high deductible healthcare plan, I will be referring to it as an HDHP. So please do note that that is what I am referring to, is the underlying health plan that you have that qualifies you for the HSA as an HDHP, and it can be used for a wide variety of future or current medical expenses. And that's an important thing to remember, is that HSAs can be used for the present expense that you have or any expense incurred after you open up the HSA. An important keynote to remember is that you cannot reimburse yourself for medical expenses that were incurred at any time before the date in which the HSA was established. So the history of these accounts and a little bit of the differentiation between them and other types of accounts, such as health reimbursement accounts and flex spending accounts. So this starts back in the mid-'80s. For the National Center for Policy Analysis publishes a report about medical IRAs. The traditional IRA had been in existence since 1975, and many proponents were utilizing the aspects of it for penalty-free distributions for qualifying medical expenses, but people were still having to pay tax on that. So the impetus to have a type of plan that you could have tax advantage savings and tax-free distributions was recognized many years ago, but it took quite a while for it to actually come to fruition in the form of the HSA. So we start to see some bills come in at around 92 that start to kind of give shape to the first thing that came out, which was the Archer MSA, or medical savings accounts, which the contributions to these plans were made by the employers, but they were subject to payroll and income taxes to the employees, and you could not roll them over from year to year. So there really was kind of a limitation on the first attempt that Congress took to get these things into existence. I don't know if any of you are old enough or do remember the Archer MSAs, but they were kind of fraught with problems, and there's a reason that they do not exist anymore today. You still can't have one if you had a cash balance, but you no longer are allowed to contribute or open an Archer MSA. So in this century, we had some additional follow-ups to the 96 ruling for Archers. So we have in 2002, the Treasury Department ruling that health reimbursement accounts contributions can be rolled over year to year, but when the employee moves employers, the contributions are lost, any unused balances. So this is where we kind of come into the realm of what people commonly misconstrue as an HSA. Explaining it to my wife when she first got her health insurance at a recent job is that she was under the impression we had an HSA, but the debit card you get provided by your employer, if you are not separately making contributions to an account, more likely than not will be a health reimbursement account, not a health savings account. And it's an important thing to denote, because if you are covered under a plan that has a health reimbursement account, it is more often than not going to be a qualifying qualifying HDHP coverage for an HSA establishment. And then in 2003, HSAs are created. And the great thing about these is that it allows portability from job to job. You can roll over accumulated funds from year to year, and any individual covered under the plan of your HDHP can utilize the funds to reimburse medical expenses. This is especially nice for families that have dependents, such as children's or other individuals that would fall under a dependent status for you. If they are covered under your HDHP, you can utilize those funds to pay or reimburse for medical qualifying qualifying medical expenses. So to enumerate a little bit, we covered the MSA, but the flex spending accounts are going to be something that also are commonly misconstrued as HSAs. And I do kind of go back on this several times because it's very important to remember that not all types of accounts that you utilize to either pay for or reimburse yourself for qualifying medical expenses are the same, and neither are your abilities to have certain accounts if you do have other ones, because they are exclusionary to each other. So a flex spending account, such as a health reimbursement account, covers the expenses not paid by insurance, including deductibles, co-pays, and co-insurance. Under the ACA, you can carry over up to $500 from year to year, and it's offered by employees alongside traditional healthcare plans. Now, an FSA differs from an HRA, so flex spending account versus a health reimbursement account, in that the FSA is offered separately to the insurance plan, and a health reimbursement account is offered within the actual plan of healthcare coverage. So the FSA is going to be something that your employer sets up. It is going to be a tax saving strategy for the business and a cost savings for them on deductions and reduction in medical the medical plan costs to them. The maximum contributions for these are $2,600 per year. And just like health reimbursement accounts and the older Archer MSAs, they are not portable job to job. That's one of the big key benefits of having an HSA, is that you can roll it over from job to job. You don't have to get rid of it or start a new one every time you change jobs, because you are going to be getting this type of coverage more often than not on the private market or through the Affordable Care Portal. This is a little bit different. Before the ACA, there were a lot more jobs offering HSA qualifying coverage, but since the ACA came out, we are seeing a lot more of those be on the marketplaces or private coverage as opposed to businesses offering them. So some of the inherent benefits to an HSA are that it encourages you, the individual, the covered individual, to make more informed choices about your healthcare. If you are spending your own money, the thought is that you're going to be doing a little bit more research on what is actually happening, and it can have the potential to drive down healthcare costs. The unfortunate aspect to this, and my thought process is that if the government wanted to make this stuff more widely available, then the Affordable Care Act is kind of precluding this with some of their plans. So the driving force behind the legislation on this isn't exactly realized, because more people are on plans that do not offer the ability to have an HSA. And the nice thing is that it's a special savings account just for health expenses. You don't have to worry about dipping into personal savings or retirement savings. You can segregate your expenses directly to one account that you get tax-free distributions from and tax-deductible contributions into on an annual basis. And you can use it to supplement your current healthcare coverage. So if you're happy with what it's covering and you're not getting sick and you're not really utilizing your healthcare coverage, you are still getting the benefit of having a reduced tax bill at the end of the year. And then if you do have anything that isn't covered, like a major medical procedure or a major expense, you can then reimburse that or continue to allow your monies to grow tax exempt and repay yourself at a later date. So some additional benefits of this, these things grow just like a traditional IRA for some reasons or for some aspects. So you have tax-free growth on the investments. So everything grows completely tax-free. Now, there are instances where you may have to if you were to take monies out of an HSA, you'd have to pay taxes. But if you're utilizing the HSA for its intended purpose of reimbursing yourself for qualifying medical expenses under an HDHP, then you get the benefit just like a Roth IRA, which is amazing. And then you also can contribute up to $3,400 a year to it if you are an individual, and I believe 7,000, it's 3,500 and 7,000, which we'll get to on the next slide, for individual versus family coverage. And the interesting thing with regard to this is that you also get to treat this as, let's say you're incredibly healthy, you get to kind of treat it like an additional IRA once you reach the age of 65. So we'll get into the ability to turn these things into a few different, and we will frame this in a few different scenarios of utilizing it for qualifying keep wanting to go to education savings accounts, utilizing it for qualifying medical expenses that are outside of the parameters of your plan, or utilizing this more as an additional retirement savings tool and planning on utilizing it as a tax-deferred investment strategy. So individual versus family HSAs. It is relatively easy to delineate which type of plan you have based on the type of household that you have. An individual HSA is going to cover just you. If you have no dependents, or if you are just focusing, or if you have no dependents or you have no one else that is covered by your healthcare plan, then an individual HSA is what you're going to establish. If you are covering your dependents with your HDHP, then a family HSA is what you're going to be able to utilize. And the difference between these two is primarily going to be seen on the amount of contributions that you can have in a given year. Yes, there is a download. If you have signed up through this, please just send me an email at aperny@advantaira.com, and I can send you the slides, and it will also be hosted on our YouTube channel. Thank you for the question. So this is where we're going to really get into the nuts and bolts of what exactly it means to qualify for one of these, because unfortunately, as much as everyone would love to be able to have an additional type of savings account, tax deferred, tax exempt, tax-free growth type account, not everyone can have one. And unfortunately, one of the aspects of the Affordable Care Act is that the types of plans being offered through the marketplace, more often than not, even for the very high deductible, high out-of-pocket coverage ones, preclude you from being able to have one for a few of these reasons. The main one is copays for office visits and prescription drugs. So with a high deductible healthcare plan that qualifies this, you're going to need to either be paying $0 for regular visits, so it's completely covered under the HDHP, which more often is not going to be the case, which is mean that you're going to be paying full price for the prescriptions and for your office visits. If you have copays for that, it is going to be a preclusion from an HDHP in order to have an HSA. So the thing to look at is, even when you look at the marketplace on the ACA during open enrollment, you're going to see plans with, I've seen plans when I've looked through it, $13,000 out-of-pocket maximums for an individual plan, and self-care. It's kind of wild to see these high deductibles that don't necessarily fall under the qualifications of a qualifying high deductible healthcare plan for the purpose of an HSA. So you cannot have any copays for any type of office visit or prescription drugs other than preventative care until you meet your deductible. Preventative care includes annual physicals, prenatal, well child exams, immunizations, and certain screenings. So certain screenings are going to be things such as breast cancer screenings, prostate screenings for individuals, for men over the age of 55, I believe, and other certain things that are commonly accepted within the parameters of preventative screenings. Now, if you go to your doctor, let's say every 3 months for a checkup, and you do have a copay for those in between visits, that's where it gets to be very nuanced in this, is that you can have your copay for an annual physical, but not necessarily an intermediate office visit. So it's something to really look at. The best way to kind of understand if your healthcare plan does qualify for an HSA is honestly just to call your healthcare provider and ask if it's HSA qualifying coverage. If they don't know, I would maybe recommend asking for someone else that might know, but typically they should be the ones that are understanding if it is HSA qualifying coverage, because the onus shouldn't necessarily be passed to you to determine this. They should be the ones telling you if it does not qualify you for that coverage. So your out-of-pocket maximums are going to be $6,550 for the HSA single plan and $13,100 for family coverage as of 2019. Now, you cannot have any other healthcare coverage with having an HSA. So you can still have an HSA even if you change insurance. Let's say you get off of an HDHP and you go to a more comprehensive healthcare plan that has lower out-of-pocket. You don't have to distribute the HSA if you've started it and been contributing and earning in it for several years. You can maintain that plan in perpetuity even if you don't have the qualifying coverage anymore. You just had to have had it once you had established it and maintained it for long enough. And we'll get into the rules for the first day of the last month here in a moment, but understand that you can't have any other healthcare coverage at the time of establishing it or while you are trying to make contributions to that HSA. However, you can have things like dental, long-term or disability insurance, or be covered under workman's comp. But if you are going to try to get two separate insurance policies to cover you for health for any myriad of reasons that are outside basically dental, vision, long-term disability, that would preclude you from making those types of distributions. And you cannot be enrolled in Medicare and cannot be claimed as someone else's dependent. You can have dependents covered under the family plan, but if you yourself have dependents and then are also trying to be claimed as a dependent for someone else, then you cannot have you cannot be contributing or establish an HSA. Come on. Okay, so I alluded to it in the last slide, but the first day of the last month. This is a very important principle to understand for knowing how much you can contribute to an HSA. Now, the nice thing about an HSA is that if you have healthcare coverage, high deductible healthcare coverage bound by the last day or the first day of the last month, then you can make a full contribution for that year, even though you didn't have coverage on January 1st through the entirety of the year. So this is really nice. So let's say you enroll in a HSA plan during open enrollment November 30th or December 1st even, you can make a full $7,000 or $3,500 contribution, depending on if it's a family versus individual plan for the entire year, even though you maybe only had 31 days of HDHP coverage. However, what you need to understand is that if you lose your HDHP coverage anytime within the following 12 rolling months, now this is from the date of establishing the HSA and the coverage. If you lose that coverage, then you have to take a prorated distribution of the months that you were not covered from that. So let's say you were only covered for 10 months, you would have to distribute, you would divide 7,000 by 12 and then distribute the multiple of 2 from the account and pay a 10% penalty for that. Who should we ask if we have an HSA? Ed, I'm not exactly sure what that's pertaining to. I can certainly answer most questions, but if you could be a little bit more detailed in what exactly you're trying to get, I'd be happy to address that. So if Ben enrolls in an HDHP November 30th, he can contribute that should be updated to $3,500 to the HSA for the account for that year and take the deduction on his tax return. If he loses the coverage prior to November 30th, he must take a prorated distribution from the HSA account. This distribution is subject to taxes and a 10% penalty. So you just have to understand how to do pro rata calculations. It's not too terribly difficult. And then you can determine if you lose that coverage, how much exactly you would have to pay and what you exactly have to distribute. So contributions to an HSA account. 2019 contribution limits for a self-only coverage is $3,500 and HSA coverage is $7,000. If you are over the age of 55 and a half, you have an annual $1,000 catch-up that you can do to either HSA for self or family, bringing your contribution limits to $4,500 if you're over the age of 55 and a half on a self-care plan, or if you have a family care plan, $8,000 per year. Contributions must be made in cash. You cannot do them as an in-kind or anything other than US dollar value equivalent into the account, meaning that you don't actually have to have paper money, but it has to be in the form of a check, bank wire, ACH into that account. You cannot contribute something like gold or cryptocurrency or property or vehicle into an HSA account. It has to be done in cash. You can do a one-time funding rollover from a traditional or Roth IRA to an HSA to fund the account, but you are subject to the annual contribution limits. You cannot use SEP or simple funds for this. Now, it's important to note, and this is a question that I get fairly often with regards to these accounts, is that you cannot exceed the $7,000 or $3,500 limit for the HSA by virtue of the rollover from the account. So you can only just basically use the traditional or Roth IRA to roll over up to that amount, not exceeding it. Now, I would typically recommend people look not to utilizing a Roth IRA because Roth IRA distributions can exempt you. You can exempt yourself from the early distribution penalties for qualifying medical expenses. And also your basis, i.e. your contributions in a Roth IRA, are always distributable, tax and penalty free. So you can utilize those in a similar way to an HSA without having to worry about paying taxes on it, such as in a traditional if you were to try to take that money out and pay for medical expenses. So if you have a traditional IRA, that's typically where I tell people to look if you are trying to utilize it for an initial rollover contribution to an HSA account. Now, more often than not, with the current Affordable Care Act governing healthcare in the United States, employers are typically not going to be offering HSA plans, although they do come up. I'm kind of a good example. My wife does have an option to have us covered under an HSA plan, but more often than not, you are going to see FSA, HRA, and non-flexible spending type plans offered by employers. But with that said, the contributions to the HSA can be made by the employee or the employer on behalf of the employee, and they are tax deductible if they are made by you. If your employer is making the contributions to an HSA, it is not deductible to you. They get to capture that deduction on their corporate returns. And deductions can be made even if you don't itemize. Now, the nice thing about that is that sometimes you are not able to deduct traditional IRA contributions if you make more than a certain amount of money in a given year in your family filing and your family's household filing, but HSA contributions are always deductible. So it is a nice additional amount of money that you can deduct, and you also get the tax exempt growth status of that as well. So distributions from an HSA are tax-free regardless of age or how long the plan has been in existence, so long as it meets these two requirements. Distributions are for qualified medical expenses, and the IRS does give a comprehensive list of qualifying medical expenses, so you can refer back to the IRS to see if it is a qualifying medical expenses and the expense is incurred after the HSA is established. So if you had surgery on a Tuesday and you established the HSA on a Wednesday, unfortunately, you cannot use those funds in order to reimburse yourself for the expenses of that procedure. So just keep that in mind if you are looking to possibly have some type of medical procedure or you are going to be incurring a high amount of medical expenses, it's a good idea to go ahead and get the account set up so you can capture the deduction and then also utilize that for payment of that medical expense as well. So the healthcare plan deductible is a qualifying I keep wanting to say higher education expense, is a qualifying medical expense. The cost of your doctor's visit, so keep in mind that's because you do not have the copays, you can utilize that to pay your doctor's visits. Dental care, for most things in dental care, so long as it is not cosmetic, things like veneers or I don't know exactly what else you would do for as far as vanity on teeth, but so office visits, x-rays, fillings, braces, root canals, medically necessary dental care, vision care, only if the expenses are not covered by another plan. Because remember, you can have a vision plan, but if your vision plan covers a part of it and you just have the remainder of your personal responsibility, then you cannot utilize the HSA to reimburse those types of expenses. It has to be something where the vision plan does not cover it at all. For instance, if it does not cover contact lenses, you could utilize it to pay for contacts. But if you do have a personal responsibility portion in that vision plan that pays for, let's say, half of your contacts, you cannot use the HSA for the other half of the contact lenses. Now, medications, so long as that it is they are medically necessary, OTC medications can be covered, but they have to be prescribed. Any prescription that the doctor writes for you for a qualifying medical scenario, I guess is the best way to put it. So if you are going through something that is a cosmetic procedure, then it wouldn't necessarily be covered under HSA guidelines, and you couldn't use it for the ancillary issues that come along with that. And insulin and things like that are also certainly covered by HSA. Richard, if you would like a copy of the slides, please email me at aperney@advantaira.com, and we can certainly send those to you. Now, if you are curious to know more about exactly what type of expenses are covered by an HSA, I would recommend that you reference IRS Publication 502. Now, most of the time when people hear that they need to read a publication by the IRS, they kind of get a little bit leery about it. It's really not that bad. It is, in most senses, a big list of qualifying medical expenses. So it's pretty easy to get through, and it does answer a lot of questions most people have. Again, that is IRS Publication 502. If you have questions specifically pertaining to HSAs and you want a definitive answer from the IRS, that is the publication that defines the parameters for these types of accounts. So not a bad read, but certainly isn't the most interesting thing to read either. Now, some things that people don't realize are qualifying expenses are things like chiropractic, bandages, and other OTC first aid items, disabled dependent care expenses, capital improvements to homes with the main purposes of medical care. So if you have a therapeutic item that's need to be installed in your house for a qualifying medical expense, then you can use an HSA in a tax-free manner to pay for those home improvements. Long-term care, psychiatric and psychological care, and lodging and trip expenses for medical care. So if you have to travel to another city for medical expenses, let's say you are a cancer patient and need to receive treatment in another city, you can pay for the entirety of that trip with an HSA if that's the sole reason for your going. So everything from the hospital expenses to the lodging expenses to plane tickets and everything else can be reimbursed to you tax-free from an HSA if you are going for the sole purpose of receiving care for a qualifying medical expense. Doug asks, if your glasses are covered by another plan, but you wish to purchase another pair, can you use your HSA to pay for the second pair? My inclination to that answer would be no, because you do have coverage that covers glasses. So even if you elected not to utilize that insurance, you still have coverage for something externally from the HSA. So I would think that the HSA then would be a no for paying for a second pair of glasses. You could probably still make the argument, though, that if your insurance only covers one pair of glasses and therefore the second pair is uninsured, then potentially, yes, you could use the HSA to make that purchase of a second pair of glasses. Unfortunately, there is some ambiguity in this. The IRS only gives us so much guidance in Publication 502 as to how that kind of stuff would play out. So for something as small as a pair of, well, perceivably small as a pair of glasses in comparison to other medical expenses, I would say that you're probably about 50-50 on whether that would be okay or not if you do have vision insurance. If you don't have vision insurance, absolutely fine. You can definitely pay for as many pairs of glasses as you realistically need with an HSA. Great question. So non-qualifying medical expenses. So healthcare plan premiums, except for COBRA benefits. So if you did have an HSA and you then became unemployed and you needed to pay for your own medical expenses through COBRA, you could pay for those premiums utilizing your HSA account. Non-prescription drugs that you do not have a prescription for. So something like Advil, if you just need Advil for maybe some mild chronic pain, but you do not have a prescription for prescription Advil, which most people know you can just divide the one pill dosage into however many Advil you need to take over the counter. If you do not have a prescription for that, then you could not utilize your HSA for that. Anything that is cosmetic weight loss, so bariatric surgery for medically necessary reasons, or if it's ordered by a doctor pursuant to some type of diagnosis, then that would be covered. Cosmetic surgery, so things such as non-medically necessary rhinoplasty, breast augmentation, skin peels, facelifts, things like that could not be covered by an HSA. Teeth whitening, nutritional supplements, cosmetics, hygiene products, babysitting, health club dues, medical expenses reimbursed by an FSA or medical savings account. So if you had a portion of your plan that covered something with an FSA, or you had a remaining balance from that, and let's say you had an old HSA, you could then not in turn use the HSA to pay for that additional medical expense that you incurred from what was not covered under the FSA or the medical savings account. And payments for future medical expenses, you have to either be paying at the time of tender for the request for payment for it, or it has to be something that you are reimbursing yourself for in the past, so long as it was incurred after the establishment of the HSA. So just keep that in mind. If you get a bill for something and they say, hey, if you're going to come in for surgery in 3 weeks, here's the bill. You cannot use the HSA to pay for that until you actually incur the expense or you go in to get the procedure. Now, it is your response. Oh, you got a question? All right, Ed asks, if we have insurance, but the employer does not know if we can contribute to HSAs, do we ask insurance company or HR? I would ask the insurance company. HR, even though they may be very knowledgeable in the coverage that is applied, ultimately the responsibility to understand the offerings is going to fall to the insurance company. So I would always ask the insurance company if the plan that you have that are covered under the business with is HSA qualifying HDHP coverage. So now I keep reiterating that the expenses that you incur can be reimbursed to an infinite amount of time after they were incurred. But the responsibility to maintain the records is on you as the individual. So you need to show that the distributions were exclusively to pay or reimburse medical expenses. So you don't necessarily have to show, hey, I went here and wrote them a check. You can pay for it personally, but you need to maintain that receipt for as long as you plan on reimbursing yourself. And you can do that 30 years afterwards, but you do have to have copies of those receipts. So make sure that if you are storing these things, it is on durable storage media. I would recommend that you scan things and then store them either in cloud service or a durable hard drive or something that you're going to know where it is for a very long time. Because if you have a $20,000 medical procedure and you are and you can pay for it personally and potentially have that be a deductible expense to you in a given year, or sorry, that you have not taken as a deductible expense in that given year, and then further on down the road after you've accumulated earnings tax exempt in that plan, then you can distribute funds to yourself, but you have to have proof that that distribution, in order to be tax-free, was associated with that medical expense. So, and also keep in mind that if the medical expense had been reimbursed from another source, so if someone else had come in and paid or helped you pay for something, you could not then in turn in the future take a distribution tax-free or qualifying HSA expense in order to reimburse yourself for that. So here's some examples of how this works in regards to future distributions. So in this example, Joe opens a self-only HSA and makes a full $3,400 deductible contribution. Joe has $1,000 of qualifying medical expenses from May through December of 2017, and at the end of the year takes a $1,000 distribution from the HSA tax-free. The remaining $2,400 plus any account earnings remain in the HSA for future expenses. 2018, Joe makes another $3,400 deductible contribution to the HSA. In March 2018, Joe has surgery costing $3,000 out of pocket. He makes an immediate distribution in March to pay expenses. Joe leaves $2,800 in the HSA and accumulates $500 more expenses in 2018. So in 2019, Joe has $2,800 in the HSA plus earnings. The HSA has accumulated $500 of qualified medical expenses, but he does not take the reimbursement. In January, he makes a $3,400 deductible contribution to the HSA. During 2019, he accumulates another $1,000 of qualifying medical expenses, but takes no distributions. So you can kind of see the strategy here. He's incurring some small medical bills, and he's not reimbursing those. But for the larger one, like the one back in 2018, the $3,000 expense, he did immediately take a distribution. So now in 2020, Joe has $6,200 plus earnings in the HSA and $1,500 of expenses. Joe again makes his annual contribution and accumulates $1,000 or so in expenses. Joe takes no distribution from the HSA. So now in 2030, at the beginning of the year, Joe has been making his annual contribution, max annual contributions to the HSA plan, and he has $60,000 in the HSA. Contributions and earnings is what makes up this $60,000 figure. In the last 12 years, he has had $20,000 of qualifying medical expenses, but took no distributions. So in 2030, he takes a $20,000 tax-free distribution from the HSA to reimburse himself for the past 20 years, or for the past 12 years of medical expenses, totaling $20,000 of tax-free distributions. So let's say he retires in 2031. Joe decides that he wants to remove some of the funds from his HSA, but has no more qualified medical expenses. So his options are, if he is under the age of 65, the distribution from the HSA are subject to income tax and a 20% early withdrawal excise tax penalty. If Joe is over 65 or has become disabled, the 20% penalty does not apply, but the non-qualified distribution is subject to income tax. So this is where the HSA gets kind of interesting in the fact that once you reach the age of 65, you can then utilize the HSA as an additional traditional IRA for the purposes of distributions. If you're going to be covered under Medicare at that point, in which case your HSA could no longer reimburse you for high deductible healthcare plan out-of-pocket expenses, then that's a great way to look at it if you want to go into the Medicare program to reimburse to utilize these kind of plans as an additional traditional IRA. Now, when it comes to beneficiaries of HSAs, things get a little bit different. Most people understand that with a traditional IRA or Roth IRA or many other types of retirement accounts, if you die, the account becomes one of your successor beneficiaries' direct account, whether in the form of a beneficiary IRA or a spouse's treat as their own IRA. HSAs are a very big departure from this. If you name your spouse as the beneficiary, then the spouse can treat the HSA as their own HSA and use it for qualifying medical expenses. That is the only person that can do that. Any other non-spouse beneficiary, the HSA ceases to be an HSA account, and the value of the HSA is taxable to your beneficiary in the year in which you die. It is not taxable to your probate estate. It is taxable to the individual that is named as the beneficiary. If you name your estate as the beneficiary, then the HSA would be included in your final income tax return. So there are definitely some end of life choices to make for this, that if your spouse predeceases you, then it might benefit your beneficiaries of your estate to name the estate as the beneficiary of the HSA, so that way there might be some tax planning strategies with regard to your estate, especially if you utilize living wills or other types of strategies to help mitigate taxes, or the probate process in general, to help minimize the tax burden on your beneficiaries, especially if you have a large HSA. So now, how can these funds be invested? The nice thing about these accounts is that they aren't necessarily restricted to just cash accounts. You can invest them in any way that your custodian that holds it will allow you to invest. So and this is an actual true example, I do have a client that owns several rental properties in their HSA. They maxed out their contribution every year for several years, and then together with I believe it was his brother's HSA, partnered together and bought some rental properties, and those things cash flow every month, and they either take the distributions out of the account for qualifying medical expenses, or I believe they are pretty healthy and just let the funds accrue over time. But real estate, promissory notes, or any type of other type of non-traditional asset are the types of things that we cover here at Advanta as far as what we will allow clients to invest in. However, there are some restrictions on several things that you cannot invest in with any type of retirement account. You can't buy a life insurance policy with an HSA. Now, this has a little bit more bearing than IRAs or 401ks. The HSA cannot be the beneficiary of a life insurance contract. You can also not pay the premiums for a life insurance contract that you personally hold and have outside named beneficiaries with HSA qualifying distributions. So just keep that in mind. That has a lot more to do with HSAs than IRAs. But life insurance, to name a HSA the beneficiary of a life insurance policy, is not allowed. And you cannot buy anything that inherently, excuse me, derives its value from collectability. So things like antiques, alcohol, artwork, stamps, rare coins, although you can buy gold and silver investment grade coins with an HSA if you would like. So there are certain people that you cannot invest with regard to an HSA. The HSA owner or spouse cannot directly buy anything or sell anything from an HSA. Your children or your parents cannot buy or sell anything to an HSA. Now, keep in mind that this is going to be outside the scope of reimbursing qualified medical expenses. Ooh, good question, Ed. Can you transfer an HSA to an IRA and be part of an RMD? Unfortunately, no. HSAs can only be transferred between HSA custodians. You cannot utilize it as far as a reverse funding back into an IRA, although you can do an IRA initial one-time funding rollover to an HSA. But that's a really good question. Even though after the age of 65, you can treat an HSA like a traditional IRA, you cannot go the opposite direction and actually take those funds and contribute them to an IRA to help satisfy a required minimum distribution. And the nice thing with an HSA is there are never any required minimum distributions with that type of account, even though you can treat it as a traditional IRA after the age of 65. So the spouses of your lineal descendants, so anyone essentially directly up and down from you in your family tree, you cannot directly invest with regard to your HSA funds. So here's some case studies about how you can invest in HSA. So Heather wants to invest in real estate. She's covered by an HDHP, and she wants to deal with others who buy, fix, and flip property. Heather has $20,000 as currently invested in an HSA in a more traditional sense, but she thinks she's going to realize better returns by lending the money on an equity participation note to people that will be involved in the property that will keep her from having to be directly involved in the day-to-day. The way an equity participation note works is that instead of principal and interest, your HSA would receive back a portion of the profits after the property is sold. So you lend the money to someone, hold the mortgage, and then they pay you a portion of the profits along with your underlying principal. So Steve is looking to acquire a property, and he needs $20,000 to cover the rehab cost in order to sell the property. So Laura offers to lend Steve the $20,000 from her HSA and split the profits when the property sells. The terms of the note are as follows. She lends $20,000 out of her HSA. She will get 25% of the profits, and the HSA will be secured by a first mortgage on the property. The total profits on the sale are $30,000. So the tax-free income back to Heather's HSA is $7,500. Heather now has $27,500 in an HSA that can be used for any qualifying medical expense incurred since she started the HSA. Heather can continue to grow the HSA through additional investments and take tax-free distribution at any point down in the future. That's essentially it for HSAs. I know there's a lot of information to kind of cram in about an hour. If there are any questions, again, please remember to contact your healthcare provider if you have any questions with regards to whether or not your plan does allow for HSAs. Other than that, it's not something that I would recommend contacting your HR department about. You really need to contact the plan provider of that high deductible healthcare coverage. And keep in mind that these are not as common as they used to be. But if you do have questions about qualifying medical expenses, the first day of the last month rule for making your contributions in a given year and maxing out the contributions, or possibly doing a pro rata distribution if you no longer have that coverage, I can help with any of those types of questions. Feel free to reach me directly at my extension, or my email address is listed up here. I hope everyone has a wonderful rest of the day. And again, if you have any questions, please don't hesitate to contact us. We are more than happy to help. A question. Caleb asks, can it be used for deductibles? Also, you can use it. You can use it for anything that is not covered by your plan, but keep in mind that if you are paying out of pocket that counts towards the deductible, then yes, you certainly can, but there cannot be any co-payment or co-insurance that has to be paid for the office visit that you are reimbursing yourself for with regard to that deductible. So if you have a full pay office visit that you are utilizing the HSA to reimburse yourself for that counts towards the deductible, then yes. But if it is a co-payment or co-insurance, then no, you could not do that. Let's see, Doug, did you say that you can do a one-time rollover from an IRA, Roth, or traditional into an HSA? Yes, you can, but keep in mind that it's going to be limited to the $3,500 or $7,000 contribution limits. So you can't just necessarily take a $100,000 IRA and roll it directly into a HSA. You are going to be covered by those limits. So, it is unfortunate, but those are the limits that are going to be imposed by that. All right, well, if there's no additional question, is the rollover from a traditional IRA taxable? No, Greg, it is non-taxable rollover. Anytime you're talking about a rollover, inherently pretty much should be non-taxable, but yes, it is non-taxable from a traditional IRA. And that's why to keep in mind that there really isn't a benefit to doing it from a Roth IRA, because you're already getting the tax-free and penalty-free distributions of the contribution basis in those types of accounts. So although you are allowed to do that one-time funding rollover from a Roth IRA, I highly recommend you look at that unless you really need to do it. Try to make it from a traditional IRA if you need to. So yeah, great questions, everyone. I really do appreciate it. I understand this these things can be a little bit dry, but we try to make it as digestible as possible. Greg, can you do the traditional rollover every year? Is it just one time? Unfortunately, it is one time only, and it has to be for the initial funding of the account. It cannot be done in a subsequent year. So if you establish the account, you can do a one-time initial funding rollover, and if you want to do it later on, unfortunately, if you've already funded it with any amount, then you could not do that. All right, well, it looks like that questions have kind of dried up. Again, if anyone wants a copy of the slides, please let me know. Give me a call if you have any questions. Hope everyone has a safe and wonderful weekend, and thank you for joining us.